So the recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. It could go down, easily go down 30%.
That right there is Jim Rickards, and he's giving us a stern warning that a big crisis is on the horizon. And we don't just mean minor downturns that eventually lead to a smooth ride ahead for daring investors. We mean a truly monumental collapse. Think 2008, but worse. The bad news is that it's already pretty evident. All you need to do is take a swipe at the news or observe the state of banks, loans, and mortgages. Banks are tumbling like dominoes, and the once mighty dollar is teetering on the edge. As the chaos unfolds, a burning question lingers. Will history repeat itself, especially when it comes to the twists and turns of economic crises? Join us in this video as we take a deep dive into the growing economic crisis, the recent bank failures, their causes, and the ultimate leverage to ride the wave of the oncoming crisis. The deplorable state of the economy has been quite visible this year. We all saw inflation, massive layoffs were made, and several businesses collapsed. But was it actually a recession? Not quite. Economic experts predict we're going to see one later this year or early in the next. But the question is, why? In the past 2 decades, America has had a recession in 2000, 2007, and 2020. With a reasonable stretch between those years, one might think recessions come in cycles. But the truth is that they're completely random. No one can predict for sure how the world of finance will turn out, not even the experts on Wall Street. If you can remember correctly, we've had back-to-back recessions once before, in 1980 and 1981. And while some experts say we're closer to a soft landing than a recession, Jim Rickards sees things differently. As a matter of fact, not only does he think we're going to get a financial crisis, but he also believes it will be far worse than feared. Not to cause any panic, but when a financial crisis happens during a recession, it always leads to disaster. Not just to the country alone, but also to the world. Remember the mortgage crisis that lasted from 2007 to 2008? Yeah, it was pretty ugly, because the crisis was fueled by the expansion of mortgage credit, granting easy access to borrowing and mortgages. This miscalculation led to the bursting of the housing bubble in the US, resulting in a severe decline in home prices. The aftermath of the crisis affected not only Americans, with many losing their homes, their savings, and their jobs, but it also had global repercussions due to the interconnectedness of the world economy, with America as the center of world trade. We hate to seem like the bearers of bad news, but look at this.
We've been talking about recession, inflation, deflation. It says there was no recession. The economy was fine in 1998, but the financial world almost came to an end. Sometimes they come together, and that's what happened in 2008.
We may just see another scenario like that, but it will be worse. And to put things into perspective, the 2008 crisis caused a loss of over $2 trillion in global economic growth. For now, Jim Rickards is suggesting that a situation similar to the Great Depression of 1931 and 1933, marked by multiple bank failures, consecutive currency devaluations, and a global trade shutdown, may be unfolding. And no, this isn't just mere speculation. Some signs are already here. Curious about what these signs are? Let's start with the diminishing world trade. According to the WTO, trade is expected to worsen as the months go by. And we won't even get started about the fact that we're seeing sky-high interest rates right in front of our eyes. And to make things worse, according to a report from Forbes, a storm of layoffs happened across various industries, with nearly 194,000 American employees finding themselves out of work. And this was months ago. Still in doubt that a recession or financial crisis is already upon us? Alright then, how about we take a look at what's happening to some of the biggest banks today? Credit Suisse, one of the world's largest banks, and the second largest in Switzerland, faced a collapse in March, leading to its acquisition by a rival for $3 billion. And how about Silvergate? How could a bank worth over $5 billion as of last year announce bankruptcy in March too? Still in doubt? Silicon Valley was taken over by the FDIC in March over financial issues. And while you can blame it all on poor management, even Signature Bank was taken over by the FDIC as well. Want to know what all these scenarios have in common? They all happened in the same month. First Republic Bank experienced a major financial crisis, facing a $30 billion liquidity challenge. On March 16th, 11 banks intervened to rescue the bank, addressing the liquidity issues after First Republic lost approximately $70 billion in deposits. Jim Rickards highlights that the aggregate losses faced by creditors and stockholders of these financial institutions exceeded $200 billion, and that is a significant financial setback. As expected, the recent bank failures have raised concerns about the stability of the financial system, leading to public panic and skepticism. While both of those feelings are understandable, the FDIC is working around the clock to create measures to regulate these banks and reassure the public about the safety of their money. How may you ask? Well, allow us to paint a bigger picture. In an unprecedented move, the FDIC guarantees depositors at Silicon Valley Bank and Signature Bank an insurance deposit of over $200 billion, well beyond the usual $250,000 limit. While this may provide temporary reassurance, Jim Rickards believes that such actions could deplete the FDIC insurance fund, ultimately burdening consumers and individuals at the bottom of the economic ladder. Additionally, the Federal Reserve's decision to provide additional loans to member banks through the Bank Term Funding Program has raised a couple of eyebrows and, frankly, confusion within the U.S. banking system. Jim Rickards speculates that the total cash volume for these loans could surpass $1 trillion. And while the motives behind these rule-breaking moves may be good, questions need to be asked. Are they driven by the need for a new policy, or could it be that they're just trying to rescue some influential figures that have been affected by the recent bank failures? With all of these in mind, we can't help but wonder if the government has forgotten that American bank portfolios now have unrealized losses exceeding $700 billion. The efforts to reassure the public about the safety of the banking system, including providing cash to depositors, are definitely not enough to quell the growing panic. The lingering uncertainties and recent bank failures have contributed to the ongoing crisis, and it seems that the situation is far from being resolved. Quickly recall the 2008 financial crisis we talked about, which bears a striking resemblance to the 2023 situation. The 2008 crisis originated in the spring of 2007, when HSBC's revelation of exceeding mortgage loss expectations triggered significant panic, setting off a chain of events culminating in the financial crisis. Several significant events unfolded during that time, including the collapses of institutions such as Bear Stearns in March 2008 and Fannie Mae and Freddie Mac in June of 2008. The closure of the Reserve Primary Money Market Fund and other institutions also added to the turmoil. However, the crisis escalated to a critical point in 2008 when the Lehman Brothers, considered a major player at that time, filed for bankruptcy. You might want to look at this.
Bank situation. Want to convey that it's very indicative of what the whole economy is like. So there's its particular situation, and the Fed coming in and guaranteeing all depositors. But it's a common situation. It exists pervasively. And what is it that I'm talking about? That there has been a lot of creation of debt to make investments.
Moving on, what if we told you modern-day technology is responsible for making the current economic climate even worse? Granted, technology has made things so much easier and faster, but it also comes with surprising cons. In this case, just imagine you're sitting at home, scrolling through your banking app, and suddenly you get a notification. It's not just any notification, it's breaking news that Silvergate Bank has collapsed. And your partner bank, where you have a significant amount of money stashed away, is teetering on the edge. Just think about what you would do in this situation. Take a walk to the bank that very day to file for account closure? Of course not. It's counterintuitive. In this nail-biting moment, you won't be panicked enough to frantically rush to the bank. Instead, you calmly open your banking app, click a few buttons, and seamlessly transfer all of your funds to a secure account. Whether it's $1 or $100,000, the ease of which you can safeguard your money using your phone is nothing short of remarkable. We've never had such a lot of control and flexibility in managing our assets, especially in times of crisis. So, you see, the landscape is transformed. In the past, you'd have to queue up at the bank, anticipating your turn for withdrawals, and now the scenario has evolved. Customers now have the ability to prompt banks into swift action more efficiently than ever. Plus, anyone can easily take their money and put it into assets. We're seeing how the world is shifting gradually from using the US dollar as a reserve currency of the world, and as a matter of fact, Saudi Arabia, Brazil, Russia, and Iran have all ditched the dollar to trade the Chinese yuan. And who's to say other influential nations of the world wouldn't do so too? Everyone's losing faith. If or when push comes to shove, banks will collapse, and the dollar will do so too. Jim Rickards even believes that the U.S. Treasury will soon run out of cash and have to borrow more, and that will be a major red flag that should not happen. Now, if you are currently watching this video and wondering what the government could do to prevent this, and why they haven't already, here's the neat part. A lot of things are out of their hands, and basically, there's not much they can do. Not too long ago, he tweeted about the Gold Standard Restoration Act, indicating a move to peg the US dollar to a specific weight of gold, and believe it or not, that's the sound of the alarm. If you aim to stay secure amid the impending storm, consider investing in gold, as it's one of history's most enduring commodities and helps protect investors against inflation and economic downturns. In case you haven't noticed, gold prices have an inverse relationship with recessions. The weaker the economy, the higher the price of gold. For example, when the stock market collapsed in 2007, investment demand for gold spiked and continued to rise, and gold doubled in value between 2007 and 2011. And how about the time when panic, uncertainty, and crippling fear were simply at an all-time high during the COVID-19 pandemic? At the time, the price of the precious metal hit record highs, as did inflows of gold-backed exchange-traded funds. And guess what? Gold is consistently in demand around the world, making a recession in one region highly unlikely to affect its international value. And even if a global recession happens, gold will still remain a worthy asset because of its liquidity. It's super easy to cash in when the markets are down. Interested? Try to get as many gold bars or coins as possible, or silver as a slight alternative. However, Jim Rickards strongly recommends the former. Nevertheless, don't make the mistake of assuming gold is a get-rich-quick scheme. It's the safest asset that you can use as leverage against the big tides that are coming in. And if you think otherwise, Jim Rickards has this to say to you.
Look, if you're in gold to get rich quick, I would pick a different asset class. Buy some Bitcoin. You might lose all your money, but maybe you'll make 10 times. So